Hi everyone, hope you're all doing well, and today I'm going to talk about the 4 stocks that I'm buying now. So I bought these 4 stocks last week. I'm going to do some quick points and some more recent updates with these stocks rather than a deep dive. The reason why I'm not going to do a deep dive on today's video about these stocks is because I think all of these 4 stocks, I have a video with them on my channel doing a bit of a deep dive. So if you do want that, then you can go check this out. This is going to be more for the regular guys that tune in on every video. Just a bit of an update where I'm at with every single company that I'm buying here. So hope the video is useful. If it is, hit the like button and we'll take a look. Now, if you do want to know when I'm buying and selling companies in real time, make sure you join Patreon. That's when I post when I'm buying or selling companies right then at the time of actually buying them or selling them, like Tesla last week for a 75% gain. As well as if you're on the Patreon, there is a new exclusive video up there. I did do a review of earnings last week, so some companies that I own and some companies that I don't own but I'm interested in, I did upload that on Patreon. So if you are a Patreon member, go check that out, and it is about 40 minutes long. It is quite a long video. And if you do join Patreon, you get to see that exclusive content where there's about 2 exclusive videos a week. So yeah, just thought I'd let you know on that one. The link is in the description. We'll get stuck onto the 4 stocks that I'm buying now. So number 1, and the stock that I bought most recently, which was on, I believe, Thursday or Friday, was HIMS. So I did buy some more shares in HIMS. Now, if you have a look at HIMS, this is a stock that I've been buying pretty much, I think, in the last 2 months. It's my newest stock to the portfolio, and it's currently at $7. If you look at HIMS, it has had a very rough ride on the stock market. It came through a SPAC. From a SPAC, it went from $10 all the way up to $23, and then it's just been going down and down and down and down. And eventually, in summertime, when it got around to this $8 mark, is when it kind of caught my interest, because I looked and thought, okay, we had a stock here that had a 52-week highs of $25. We're about a year on, so obviously the company's progressed, and it's at the same prices as where it was over a year ago, and it had 52-week highs of $25, and that's what really interested me originally into the stock. And when I looked at the progress this stock has made, I looked and thought, okay, this should be probably higher than where it was at SPAC prices a year ago, and it's actually below its SPAC price now. And especially in the last few months, this company has made a lot of progress, and it's not reflecting in the share price. Now, they recently brought earnings out last week, and the earnings were absolutely fantastic. And the crazy thing about this is that earnings, for me, I think HIMS and Callaway were the best earnings last week. And the crazy thing is that since these earnings have come out, all that's happened to the stock price is it's gone down. And these earnings were like 10 out of 10 earnings, and the stock price is going down. So I thought, okay, if you're giving me amazing earnings and the stock price is going down off these, I'll buy more. And that's what I did. Now, on the actual earnings, EPS was in line, which is actually pretty good for a growth company, and a growth company as well that's growing at 79% and has made 2 major acquisitions recently. That is actually pretty good on the EPS front. And I don't really look at EPS on a company that is at the moment trying to scale up its market share, but that was still very positive. And that's what I do like about HIMS and hers, is that they do have, they're not really burning through that much cash. And the good thing as well is that they have clear ways of getting to profitability, because they do make very good margins on the things that they do sell. And like I said, the revenue was strong, 74 million, 79% year-over-year growth. And let's not forget, this is a telehealth service company. So you think these have like really hard comparisons to beat from last year, and this company's just put in like nearly 80% revenue growth, a nice beat as well, and also an outlook raise, which was pretty impressive. And then you look at the progress that this company's made so far this year. Look at the progress that it's made so far. December, 40 million, March, 50 million, June, 58 million, September, 72 million. The best quarter so far really this year. And the big thing as well is that it just keeps going on them very hard comparisons as well. Now, just here, for the full year of 2021, the revenue is expected to be around 263 million to 265 million. Now, when this company actually came public, if I actually go to the SPAC presentation, they were actually forecasting 179 million this year. And even next year was 233 million. Now, you could say that they did sandbag guidance a little bit here with, going 209% growth, 67% growth. And you could say they sandbagged on 30% growth, but it was a bit like, okay, has there been so much demand pulled forward because of the CV situation? But the growth numbers they've just put in are absolutely fantastic. We are well ahead of what was in the SPAC presentation right here. And another major thing is that only a few days ago, they announced a major partnership to sell their products in Walgreens. Now, you think you're a bit of a telehealth service, selling some products as well. What is the one big contract you want? It's Walgreens. You start that partnership with Walgreens, and they've got that partnership now. Massive, massive partnership. And like I said, it comes all back to here. When I look at the share price has pretty much done nothing. All these positive news, the the company just keeps growing faster and faster, the revenue growth shooting up, they're outperforming their SPAC presentations, they sign a major deal like Walgreens. Look at the share price. You would not think all that positive news has happened because it's not even gone up, it's gone down, and it's just one of those that I'm just capitalizing on that opportunity. And as well as that, it is a very healthy company as well, with no debt, a pretty strong cash balance as well. So this company has a lot of potential to get to profitability, great revenue growth, and a very clean balance sheet. And to top it off, it's a founder-led company that's made all this progress, and it's a very new company, and also the co-founder still has nearly a 10% stake in the company. So number one is Hims. Once again, fantastic earnings, 10 out of 10 earnings for me, and the positive news that's been out there is a lot. And like I said, you look at the share price, it's down, and it's not even flat, it's gone down off all this positive news. So for me, I'm just taking that buying opportunity and buying some more. So number one is Hims. Number two is DraftKings. I've talked about this twice already last week, so I'm only going to spend about a minute on this one, but really quickly. When you look at DraftKings, once again, another company that's had a very fantastic year, grown revenue a huge amount, and the big thing is you just see the share price moving down. And as well as that, we were on a good run, and this fall off here was because of links of buying a company, and people were nervous about that buyout. Now that buyout's not going to happen, the share price isn't even recovering it just keeps going down, and you just look at that one and go, once again, positive news, moving in the right direction, one of the cheapest valuations it's ever been at, actually. And you look and think, just a disconnect once again. And before I just move on to the next one, because I said I will be very quick on DraftKings, I just want to talk about one of the most negative points that I see about DraftKings. And quite often people say, yeah, but it's okay, but what about it? It's losing so much money. And I'm just going to make this point one more time about the profitability. It will lose money for a bit. That's a growth company. That's what you are paying up for. You are paying up for the potential of what it could be. You are paying up for the growth, and that's what you've got to look at. That's why growth stocks aren't for everyone, and that's why they also trade at a premium. And the thing is with DraftKings, I ain't buying a company here which I think has the vision to get to profitability. Well, you know, when I buy unprofitable companies, I've got to see the vision. Hims, I see it. They have really good margins. They cut down the marketing if they wanted to. They can get to profitability. Same with DraftKings. DraftKings has the vision of becoming profitable. The reason why is because it launches states, and in 2 or 3 years, them states come actually profitable, and the evidence is that is New Jersey. New Jersey launched about 2-3 years ago, and it's already profitable. You can see here, I can't get the full Barron's article, but you can go through the earnings call and get a bit more information on this. The company said earlier this year that the contribution profit in New Jersey was $8 million in 2020 and projected 65 million in profits in the state in 2021. We are going to get an update from them next year about the profit side of it, but this is evidence that them sort of states do get to profit. And the crazy thing is that these states get to profit and they still grow at a good rate. You know, you can see here, revenue in New Jersey grew from 85 million in 2019 to over 150 million in 2020, and is expected to surpass 200 million in 2021. So these states are still growing at a really good rates, and then within 2 or 3 years they become profitable. And that's one thing that I see so often used against DraftKings is the negativity of that it burns through money. It only burns through money through them state launches for the first 2 or 3 years. The evidence is New Jersey. After 2 or 3 years, the state matures, they get to profitability, and them states still grow at a massive rate, and they will do that for the next kind of 5, 10, 20, 30 years. And that's why I like DraftKings. It's a company that has visions of getting to profitability, but the growth on it is still massive, and that's number 2. And number 3 is Boohoo. So I did buy a bit more Boohoo. I think this one, and this one I bought on Tuesday, I believe it was. You guys on the Patreon know exactly when, but I think it was Tuesday. And Boohoo itself seems to be looking to try and put that little bit of bounce coming in a little bit now. We did have a little bit of a shoot up, but then it did fall back again. But we are just starting to have that little bit more rally here. It was a pretty decent kind of couple of weeks for Boohoo. So we'll see. I'm still down a little bit on this position, but I have now got this to my biggest UK holding right now. And there's not much I can really add in about news about Boohoo. The only little thing that I'm going to say is that the big acquisition they made, which is Debenhams, which I think will start really paying off for them next year, is starting to get more and more open and operating again, and they have started doing sales again. They've started using the adverts again to try and get people back using Debenhams. So that big purchase they made looks like it's starting to pay off for them. But what can I say about Boohoo? You know, obviously I am massively bullish on it. I think that this is one of the best UK growth stocks. You are picking one of the best UK growth stocks with basically losing half its value from its all-time highs. And if you look at the past performance, the evidence is in the past performance of this company. Look at this, you know, profitable, ramping up that revenue up so fast, profitability has always moved in the right direction, apart from what's going on at the moment, which is the short-term logistic problems, and financially as well, on the health side of it, it's very, very strong. And I won't spend much more longer on that, because you guys that are tuning in the videos regularly, you know my thoughts on Boohoo, and yeah, it's a fantastic UK company with all that growth, amazing balance sheet, and it's lost half its share price for, in my opinion, an overreaction, so I did buy a bit more Boohoo. And the last stock on this list is ASOS. So I did buy a little bit more ASOS this week, and I'm not gonna lie, this was a stock that I was like down 20% on, and now I'm only down like 2% on. It has been on a very good run recently. And you can see here, we did kind of go down here to the lows around October time, but since them lows in October time, we have had a pretty quick bounce. We're up 24%, and that's a little bit frustrating for me, because I have only really built half of my position in ASOS, so I don't want it to get too carried away, because I still want to buy a bit more at the moment. So yeah, I mean, if it does keep going up, I won't be too fussed. I've got half my position, and that will still make some good money, but I would like it to stay around here just to carry on building that position slightly. But it has been on a good run. The recent jump in ASOS is that I think a few people are now going, oh, you know, I'm going to take a punt on it now. And they also did release some positive news. They did a bit of a capital markets day, and on the capital markets day, obviously they have ambitions of achieving 1 billion of revenue from its own brands, but they also came out, and I think this was a big thing, is that they revealed plans to double the profit margin. So at the moment, I mean, they do around about 4%, so yeah, to get up to 8% would be massive. So you think ASOS, if they get to 8% profit margins, and as well as on 8% profit margins, you think about the increase in their own brands, the revenue increase, and that would put ASOS at really good levels of profitability. So if they are able to achieve that in the long term, that would be very good. And I think that obviously that positive news is what kind of got people interested in ASOS, because that would be a lot higher than what they have ever done. And then you also factor in the revenue growth over the next few years, that would mean ASOS at the moment, if they did achieve that, would be trading at a very cheap valuation. So yeah, number 4 was ASOS, 2 UK stocks, 2 US stocks, and yeah, I like all 4 of these. And yeah, those are all the stocks that I bought this week. So hope it's useful. At the moment, I'll probably buy a few more stocks next week. There's a few things that are interesting me, especially these 2 at these sort of prices in particular at the moment with the drops they're on. But yeah, hope the video was useful. If it was, hit the like button. If you're new, subscribe. I hope this video just keeping you updated, what I'm buying, what I'm selling, and that transparency is useful. And also in the comment section, post what you've been buying as well, of course. And sometimes there's some good ones that kind of get me interested, and I add to a watch list as well. So yeah, hope the video is useful, and I'll see you in the next one.